get the views of Ansgar Belke. He's the chair of macroeconomics at the University of Duisburg-Essen. Thanks so much for joining me this morning. Are we seeing the start of a second financial crisis? Is this Lehman Brothers version 2, if you like?
So I think you cannot exclude it at all, because what you see is a domino effect, starting with the weakest link in the struggle, namely the banks. And the banks have on their balance sheets a huge degree of government bonds. This is a very difficult situation, because everybody knows if these bonds are downgraded, banks are also downgraded, and this could lead really to a hot potato game, starting with the weakest banks and then withdraw liquidity from the interbank market.
And one of the problems we've seen is interbank lending rates. I mean, they've been rising up. They're at the highest since for almost 18 months or so, but still not quite as bad as they were in the aftermath of Lehman Brothers collapse. So should we take some solace from that, perhaps?
Yes, that's really true that this is the case, but you have to see that markets are caught in contradictory observations. First, you have the European Financial Stability Facility, which is much too small to rescue also the bigger countries, and we see that also Italy is on the brink at the moment. Second, Eurobonds are not accepted by Germany at all, by the largest donor country. And thirdly, the ECB is quite reluctant still to take all the efforts on her boats.
And we've got other problems as well, not least that Greece doesn't seem to be meeting its commitments, and it's not receiving its latest bit of aid money. We've got ministers meeting in another German city, in Berlin, to discuss Finland's demands for collateral. We've also got Angela Merkel's electoral defeat over the weekend here. So how does this all play in? Are we on the edge now? Are we on the precipice?
I think we are really on the edge now, because what you see is you need an urgent liquidity infusion into the markets, because otherwise you would really risk a Lehman scenario. And one possibility to do this is to go really for a European monetary fund, as proposed by some colleagues. So in one way you have to cope with insolvent countries like Greece, and with illiquid countries, I'm persuaded that Italy is not insolvent but illiquid. You have to deal with liquidity infusions and maybe give a bank license to the European Financial Stability Facility to get for money and for liquidity infusion by the ECB.
I suppose one of the other big problems we're seeing right now across the Eurozone is this trade-off between austerity and growth. If they don't get their budgets under control, reduce their debts, they get punished by the markets. But if they do that, their growth slows down and they get punished by the markets again. What can they possibly do?
So to my mind, the results of the EU summit from July the 21st are not sufficient to all extents. What I would have expected is a much larger haircut by 50 percentage points, which was priced in the markets anyway. So what you see is the need of another great haircut, maybe 2013 at the latest, when we introduce the European Stability Mechanism. But still, acceptance is not reassured in Germany. Merkel will lose elections if a large degree of aid would be accepted, and we saw this last year in North Rhine-Westphalia, when she lost immediately the local elections after promising aid to Greece.
And just finally, just in a couple of words, if you will, what's the end game here? Is it Eurobonds? Is it default? Is it European Monetary Fund? What are we looking at?
So the end game will be something where markets distrust in politicians' ability to solve the problems. So what we might see is the dissolution of the euro area, and this will be decided in Rome.
Okay, Ansgar Belke, on that extremely cheery note, we'll end it there. Plenty more from here in Frankfurt at the Banks in Upheaval conference. But for now, Lindsay, back to you in London.